bring in Rebecca Walser, president at Walser Wealth Management. Rebecca, welcome back to the show. Good to see you.
Thank you for having me, Oliver.
Are we ever going to get out of this situation where the good data keeps causing us to sell off? I mean, last week, our rally kind of ran into a wall when our manufacturing data was weak. But now that the services data is hot, it's like we're selling off in both conditions.
I know. I think more today, I mean, we obviously saw China loosening its COVID zero policy, and that obviously did help the markets quite a bit. But then we just got data out of Europe. It's the fifth straight contraction. So that obviously has sort of bled over into the American market openings. And I still think, Oliver, too, 263,000 new jobs on Friday, and the payroll number, the average earnings went up 0.6%, which was double consensus. We only thought it was going to go up 0.3%. So when you combine all those factors, you have a mixed bag still, and this is what we're going to keep dealing with.
When we last spoke in September, the topic du jour then was the Bank of England and their bond problem. And it seems like after we had some pretty crazy volatility, I guess maybe they avoided the absolute worst. But it kind of seems like now we're still having trouble with bonds in general. We just can't quite suppress rates too far. What do you think's happening here? Is this just telling us the Powell's got a long ways to go?
Well, it's a global problem, right? We had a global bond inversion of the yield curve, and that hasn't happened since 2000. So now we see that this is really not just a U.S. 2-year and 10-year problem, and sometimes the 3-year in there as well, but it's a global inversion. And so that really spells, Oliver, we know that, the bond world, as much as we talk equities, we know that bonds actually institutionally run the world. And so when you have an inversion and you start to see that the global outlook is also potentially not the best expectation. I was listening to another commentator, and they basically calculated it's like 311 days from inversion to recession. So that would put us in September sometime next year. And so we're just battling on all fronts. It's really hard, Oliver, to stimulate through a global pandemic globally and put so much money into the system and then just think that we can just have no problem with inflation and no problem with inversions and no problem with yields.
A lot of people are trying to shrug off that yield curve. It's just no matter what happens, it just keeps going down. So the long-term case, it seems like still generally one of caution, Rebecca, you would say, for risk to the underlying economy.
The problem is it's so superficial. It's not a breath of recovery that we've experienced deeply in the United States. We just aren't there yet. We might still have some decent labor numbers, but we also have a lot of big tech saying we're laying off, having Amazon lay off before the holidays. When's the last time we've seen that, if ever? So we see that the economy is acting one way, and yet the data keeps kind of trending a different way to what reality is what we're seeing on the street. So we don't quite know how to reconcile that, and the market keeps, getting hot swings. If Powell comes out and says one positive thing that we might not be as hawkish as we've been, the market will have a great 300 swing to the upside. And then the very next day, something happens in China and they're locked down and we're going to swing to the downside. So this just tells us that we're a very fickle market that doesn't have a true sense of our direction. And so therefore, it's a cautious stance, of course.
Okay. The window here the last couple months has been quite positive for stocks, called about a little over a month and a half. But the language we've heard from the Fed speakers is that they don't really like stocks to go up. They've been pretty explicit about that now, actually, in kind of a shocking way to some degree, the way Kashkari and others have directly talked about the market. Do you think that if there's like a Fed, at least a collar now instead of a put, is there like a call where if we go up too much, then he's going to have to get more aggressive?
I think the Fed is worried that they are between a rock and a hard place. If they make this too difficult, obviously the market will bear the consequences. If they don't make it difficult enough, we will have massive inflation. So they really are in such a corner that they've backed themselves into that they have to be flexible in their comments and flexible in their policy. I feel for them. I mean, I never thought I'd feel sorry for the governors of the Federal Reserve and the presidents, but I actually do feel sorry for Jerome Powell because this is a very, very, very difficult corner to navigate successfully to get out of. So they want a soft landing, but they don't know if they can achieve it. So they have to have comments on both sides.
This is a bit of a kind of push and pull because right now seasonally we're supposed to be in a pretty good time of year. I mean, we're looking at upgrades on Lulu and stuff. People are paying crazy prices for airlines. How do we weigh that in where it seems like the consumer still has a little bit of firepower?
I noticed the trend is more towards services, right? People are buying experiences for the holidays, and still they're buying retail, and we're still buying, consumers. We're a 70% consumer society, but we are seeing a trend, as you're pointing out, Oliver, moving towards the services. And those are really interesting because you consume them and there's nothing left, right? There's no product left. There's nothing left to add to your net worth. It's a consumption item. So overall, I'd say from a net macroeconomic perspective, us moving to service consumption doesn't help our bottom line from a GDP perspective as far as ongoing, and our reliance on China still with their supply chain issues. That also worries me for this time of year. I hope people ordered their Christmas presents a long time ago.
Does China's reopening help or hurt us right now, Rebecca? What's the way we should think about that?
We need them to be. They're our largest trading partner by far and away. Obviously, what happens to them happens to the United States. It might just be a time delay, so people aren't seeing it. We need China open. We need Foxconn open. If Apple's going to have any serious ability to continue on, finally, Apple is realizing they need to maybe diversify more supply chains and manufacturing. Is obviously Foxconn's the biggest. But this is just making American or multinational corporations aware of the geopolitical risks of being in a country that is this tightly controlled.
Okay. And if they reopen, we get some trade smoothing out, but do we get inflation kicking back in? How is that connected?
If we have too hot of a market too fast, again, the Fed's problem, their big dilemma, it will overheat. We just put so much money into the system with coronavirus that you have to take these machinations to make the policy and the heat come back down. It's going to take time to get into the system fully as it has, and then to be bled out of the system, which is what the Fed is trying to do, right? They're trying to get this excess capital out, which is ironic, Oliver, because as the cost of capital has gone up so much, liquidity is now a big issue. So you can't it's such a dichotomy. We put so much in, and now we have a liquidity issue at the central bank level. It's a big problem. They're in negative cash flow territory, which is never a good thing to see.
All right. Rebecca, thanks a lot. Always good check in. Appreciate your thoughts.
Thank you, Oliver.
Absolutely. Rebecca Walser, president at Walser Wealth Management.